The Roth IRA has the same $5,500 maximum contribution limit in 2013, an additional $1,000 if you're 50 years of age or older. It has income phase-outs, though, so that certain people cannot, if they earn too much, fund a Roth IRA directly at all this year. So single, head of household, or married filing separately, and you did not live with your spouse at any time during the year. So single, head of household, married filing separately, but you don't live together. A modified adjusted gross income of less than $112,000, you can contribute up to the limit, $112,000. If it's $112,000 but less than $127,000, there is a partial contribution that you may make. If you file single, head of household, married filing separately, and you don't live with your spouse, and you had a modified adjusted gross income of $127,000 or more, you cannot contribute in 2013 to a Roth IRA. So that one I will put on the board. Roth IRA, single, head of household, married, filing separately, do not live with spouse. Do not live with spouse. Modified adjusted gross income. If your modified adjusted gross income is $127,000 or more, $127,000 or more, that's where we say no contributions. No contributions. I still don't think it's going to be on your test, but you should know it because you will have a lot of clients that want to directly fund a Roth IRA. What if your client is married filing jointly or a qualifying widow or widower? Modified adjusted gross income is less than $178,000. They can contribute up to the limit. Modified adjusted gross income of $178,000 to $188,000. How much you can contribute is reduced. Modified adjusted gross income of $188,000 or more, you cannot contribute to a Roth IRA. So married, filing, jointly, qualified, widow or widower. Modified adjusted gross income of $188,000 or more, you can't contribute at all. $188,000 or more. That's the phase out, $188,000. No. So $178,000 or less, full. Okay. The modified adjusted gross income of less than $112,000 if you were single, head of household, full. So $112,000, less than $112,000, full. Okay. So less than $178,000 up to the limit. So I don't want to say that wrong. The IRS hates me when I say things wrong. So I'm going to do it like this. Less than $178,000. There we go. Wrong way. Less than. So less than 112, modified adjusted gross income for single, head of household, married filing separately, married filing jointly, or qualified widow or widower, less than 178, full contribution is allowed. 188,000 or more, then no. So it's very likely you'll have these types of clients that are prohibited from directly funding the Roth IRA, putting the money into a traditional, and then rolling it into a Roth, which is perfectly legal currently. I would imagine that someday they wouldn't allow that anymore, but who knows? If you're married filing separately and you lived with your spouse at any time during the year, and your modified adjusted gross income is 0, you can contribute up to the limit. If your modified adjusted gross income is more than 0 but less than $10,000, there is a reduced amount. If your modified adjusted gross income is $10,000 or more, married filing separately, living with your spouse, you cannot contribute. So that's kind of a rule for all of the IRAs. It is true. You can convert from your traditional IRA to your Roth IRA no matter your modified adjusted gross income. Just remember, taxes are owed on whatever portion of the rollover that has not yet been taxed. Taxable as ordinary income in the amount of the rollover. We need to know the limits for educational accounts. So the Coverdell Educational Savings Account in 2013 has a $2,000 per year per beneficiary limitation. Per year per beneficiary. So always after tax dollars going in. After tax dollars going in. Minor educational savings account is for a minor. Earnings are federally income tax free if used for any educational expenses preschool through higher education. So this is the most you could put in this year for someone who is under age 18. It's not grandma can put in 2,000 and then the mom can put in 2,000. It's a total for that minor child of $2,000. So it's not a lot of money. You can see why 529 plans would be more popular. So the 529 plan. Now, is it possible that that child has both a 529 plan and an ESA? Most certainly it is possible. The 529 plan, like I said before, is a type of municipal security. How much you can put into the 529 plan in any given year is 5 times the current year's gift tax exclusion. 5 times the current year's gift tax exclusion. Well, what's that? The current year's gift tax exclusion for 2013 is $14,000. So basically what we just found out is that any person who wants to put into a 529 plan $70,000 can. It's after tax dollars going in. So I could put it in for Miles. My husband Bruce could also put it in for Miles. And then we could put it in for Mason and Max and Emery and anyone who we wanted to set up a 529 plan for. So you can get a lot of assets out of someone's estate pretty quickly by setting up 529 plans. It is true if, let's say, my mom was to do this for Max, put in $70,000 this year, she would not be able to gift any amount to Max over the next 5 years. So it's a speeding up of the gift tax exclusion that's available to my mom over the next 5 years. But it is the current year's gift tax exclusion amount times 5. Now, how high can an account balance get in a 529 plan varies by state. Generally pretty darn high, like 300,000. You're going to want to read the plan documents for the 529 plan that your client is purchasing because it does vary by state. I've seen in the 200s, I've seen above 350. So it really varies by state. The amount before the plan will say, you know what? No more money can come in here. It gets pretty high. I mean, if you think about how much it's going to cost to send my 4-year-old daughter to college, please don't talk to me about it, right? So that 300,000 is a reasonable amount of money that she might need to have at her disposal, which is very scary to me. So definitely we'll need to know the current year's gift tax exclusion, 14,000 times 5. And then grandma can do it, grandpa can do it for each of their grandchildren so that they can get a significant amount of money out of their estate fairly quickly by funding 529 plans. Once again, anytime the 529 plan is established, the earnings are federally income tax free if used for qualified higher educational expenses. So that's tuition, room and board, a bus pass, not buying a car or an apartment by their college, things like that, no. If you take out the money for something other than qualified higher educational expenses, ordinary income and a 10% penalty, that would be true on the ESA as well. And we can always roll these to other family members. So those are the limitations that you would definitely want to feel comfortable with for 2013. We had signed into law on January 2nd of 2013 the American Taxpayer Relief Act of 2012 because it really was created in 2012. I do want to briefly talk about some of the changes that came along with this legislation because it does have the ability to impact some test questions that you might have on your test. The estate tax exemption for 2013. Estate tax. So the estate tax exemption, or exclusion we'll sometimes call it. So here we are, $5,250,000. So what that means is that when a person dies, all of their assets are accounted for, right? So their retirement accounts, their mutual fund accounts, their savings accounts, their checking accounts, their house, their boat, their cars. It also includes life insurance that that person owned on their own life, or any life insurance that they own that has cash value. It does not include life insurance that is owned by someone else. So let's say that their spouse owned life insurance on their life. That's not included in their taxable estate. Life insurance that they own on their own life is included in their taxable estate, or life insurance that they own that has cash value is also included in their taxable estate. So we gather up all of these assets, and then what it means is that when the person died, we totaled up as of the date of death all of their assets, and all of their assets had a value of $3 million. How much is the estate taxes owed? None, nothing. So this is the exclusion amount. It's the IRS saying we're not going to tax you if the amount is this amount, $5,250,000 or less. We're not going to tax you. But if the amount is more than that, so let's say that the estate, when we valued it, had a value of $6.25 million, for simplicity's sake, $6.25 million. It is the amount that's over, so this will be the exclusion amount in effect for this year. It's the amount that's over the $5,250,000, the million in this case, that is taxable. The current year's estate tax rate is 40%. So sometimes the test just has generic questions because they don't want to update the questions with a dollar amount every year. So know that the exclusion amount is the amount that's not taxable. Know that whatever's over the exclusion amount is the amount that is taxable. The current rate this year is 40%. Something that was part of the American Taxpayer Relief Act is this concept of what is called portability. So we have portability of the federal estate tax exemption amount between married couples. It is now permanent as anything can be in tax code, right? So it's in effect right now until they change it later, but they use the term permanent sometimes. So we kind of have to talk about this. What is this talking about? When the first party dies, so husband and wife, first party dies, there's never any estate taxes owed. Everything passes along to the surviving spouse. Okay, sure, granted, some things might be titled to go to the children and things like that, but for simplicity's sake, death of the first spouse, everything passes along to the surviving spouse. The portability of the estate tax exemption amount works like this. It says that you need to be aware of what is called IRS Form 706. IRS Form 706. This is the estate tax form. It's also the generation skipping transfer tax form, which I'll talk about in a minute. Estate tax return. Now, estate tax returns are due 9 months after a person's death, 9 months after death. So I always think about, I've been pregnant 4 times, takes 9 months to have a baby, and then after I pass away, my executor has 9 months to file Form 706. Generally speaking, Form 706 must be filed whenever the person who has deceased, even if it's the first spouse, whenever their estate is worth more than, this year, $5,250,000. However, in order for the portability rule to apply, no matter the size of the first deceased party's estate, Form 706 must be filed. Okay, so basically, without having to establish what is called an AB trust, without having to do that, so we don't have to do this anymore, so long as after the death of the first spouse, Form 706 is filed, which says what is the amount of that deceased party's estate, the estate tax exclusion is going to carry forward for the person who just passed away to the second party that dies, so that when the second party dies, let's say they died at the end of 2013, they get not only the estate tax exclusion amount for the first spouse, $5,250,000, but they also have their own $5,250,000 of an estate tax exclusion. So it's this idea of portability, that we get to take with us the first exclusion amount, so that if this is done, so that no matter what, Form 706 must be filed at the death of the first spouse, otherwise they will lose their exemption amount. So if that is filed at the death of the second spouse, $10,500,000 becomes the estate tax exclusion amount, which is really great. And they don't have to put together a trust to do that, which is wonderful. They just need to know to file that form, regardless of whether or not their assets, the first party's assets, were $1 million or $6 million. So 2 times the estate tax exclusion. I don't know how quickly this will appear on the test, but it is something that is really relevant for your clients, and I can't help myself but want to make sure that you know these certain things that are so important for your clients. So IRS Form 706, United States Estate and Generation Skipping Transfer Tax Return. Estates have another income tax form that they might have to file. So first we talked about estate tax return. So we did this already. This is Form 706. Form 706 due 9 months after death. And then there is what is called Form 1041. 1041 is the estate and trust income tax return. Income tax return. So your personal return is a 1040, right? And that's due when? April 15th. The 1041 is also due April 15th. Due April 15th. When does a 1041 have to be filed? When the estate has gross income. So estates, they'll oftentimes still have earnings, so gross income of $600 or more. Gross income of $600 or more, then the estate must file the Form 1041. So there's 2 forms for estates. 706, the estate tax return form, and 1041, the estate's income tax return form. If the estate has that income of $600 or more, 1041 is due April 15th. The gift tax exclusion amount, gift tax exclusion for 2013, $14,000. That's per person. So I could send you a check for $14,000. I know you're thinking, my address is, send me a check for $14,000, right? So you can gift $14,000 to as many people as you'd like. If you were to give a gift of more than that amount, so let's say I sent you a check for $16,000, it's the person giving the gift that owes gift tax on the amount that's over $14,000. So I would owe gift tax on the $2,000. Gifts, just like inheritance, just like life insurance proceeds, are free to the recipient. The recipient of a gift, the recipient of a life insurance death benefit, the recipient of an inheritance, tax-free to the recipient. So the gift tax exclusion, $14,000. Then your client has to keep track of all the gifts they've made throughout their lifetime. So we have the lifetime gift tax exemption. Lifetime gift tax exemption. It is the same as the estate tax exclusion amount for 2013, so $5,250,000. It is not portable, however, so it is not a portable tax. So lifetime gift tax exemption, it's not a portable exemption amount. $5,250,000. Any gifts that a person has made in their lifetime that are more than that, okay, it's a 40% tax rate. So same tax rate that we have on the estate taxes in 2013. When I talked about Form 706, I said this is the estate tax return form and the generation skipping transfer tax return form. So the generation skipping transfer tax, you need to have a slight understanding of what the heck is this. So the IRS is on the lookout for assets that have been left to what they call a skip person. So a skip person is when a gift is given to a person that is 2 or more generations below the person giving the gift. I'll call them the giver. It's probably not the right English, but I'll do it anyway. Or, so this is grandparent to grandchild, okay? So this is within the family. Or an unrelated person can give a gift to an unrelated person as well. Unrelated person that is, it's a funny rule. The rule says if the person is 37 and a half years or more younger than the person making the gift. An unrelated person that is 37 and a half years younger or more younger than the giver. So these are what we call skip persons. So it's not father to daughter, it's grandfather to grandchild. Or it's a person that's unrelated to you that's 37 and a half years or more younger than you. You have to keep track of these amounts that you give to skip people because of the generation skipping transfer tax. The amount of the generation skipping transfer tax is the same as the estate tax exclusion for 2013, and it's the same as the lifetime gift tax exemption. So at least these amounts are all the same. $5,250,000. The portability rule, the ability for the death of the first person's exclusion to go to the surviving spouse, only applies to estate taxes. So it does not apply to gifts. It does not apply to the generation skipping transfer tax rule as well. So there is no portability in the generation skipping transfer tax. So that if gifts have been made to skip persons in 2013 that are over the exclusion amount, it's also a 40% tax rate. So we've got 40% estate tax rate, we've got 40% gift tax rate, we've got 40% generation skipping transfer tax rate, and the same exclusion amount for all of them, $5,250,000. The only one that's portable where you get twice is the estate tax exclusion if Form 706 is filed. In order for married couples to take advantage of both spouses' generation skipping transfer tax, they're going to have to set up some sort of special trust. There's definite documentation the IRS would require so that that portability rule is not automatic. To get the portability in estate taxes today, you no longer need an AB trust like you used to need a few years back.